I think there would be at least 25 to 30 odd venture backed startups which would go public in the next 2 years. And more, you would find the quality of that narrative of these assets which are going public even more stronger than the first two waves that we saw in 21 and last 23-24 periods. Because then these are founders tightly knit, everyone is learning from each other, and hence you will find better numbers, better governance standards, better communication, and ability to predict their own outlooks to be improving as these companies and these founders hit the public markets.
This is the TheOnePoint Podcast, and I'm Rohit Yadav. Welcome to this new streamlined format that is shorter, upper, and more impactful. In each edition, I spotlight either an insightful trend from the ecosystem or a thought-provoking perspective from a venture expert or a bold idea worth exploring further. And today I have Anoop Menon with me, whose post on India's startup IPO wave, a surge, a slowdown, and what's next made quite some noise, and for good reason. Anoop is principal in the investment team at Chiratae. He heads the consumer tech sector. Anoop worked at Accenture Ventures, partnering, investing, and acquiring startups with deep tech capabilities for its open innovation platform in India. So Anoop, welcome to the podcast.
Thanks, Rohit. Thanks for having me over here.
Can you give us a brief background about Chiratae first?
So Chiratae Ventures, previously called IDG Ventures, we've been around for now 19 years. We are a sector agnostic early stage venture capital fund with about 1.3 billion in AUM. And this spans across 7 of our funds. Our investments predominantly are in the seed to series A stages. And we have, over the years, we have about 8 unicorns. We have about 4 IPOs already in the bag and many more which are in the making. That's a quick one about us.
Okay, that's a perfect segue. So you said there are some few IPOs are in making, right? Tell us about the IPO dynamics in India, and please touch upon your recent post. It was very intriguing, very insightful. So maybe you can explain to us where we are coming from in the last couple of years to where we are.
Yeah, no, I think two key things have happened in the entire Indian venture capital ecosystem, at least from an exit perspective, right? I think in 2021, when SEBI relaxed the regulations and provided a framework where technology-backed or VC-backed startups effectively with a certain trajectory of profitability could access the public markets, automatically it opened up an avenue of exits for venture capital investors, which otherwise were stuck in sort of illiquid assets for long periods of time. The second thing which happened obviously in 2023 as such was effectively after the first wave of startups which went public, the second and third waves sort of started kicking in. And today you can ask any of the venture capital private equity investors, India IPO market as a very viable and attractive exit option has emerged, and the planning of how they look at divestments in the fund journey, fund cycles itself. So these two were the key major points. In 23, we did start off potentially with about 5 or 6 startups, Mama Earth, Yatra, Idea Forge being a few. But in 24, it clearly saw a major upswing, right? With about Swiggy, Ola Electric, FirstCry, MobiKwik, a bunch of them actually accessing the public markets. The intriguing point was we expected the momentum to continue into 25, but what we have seen is effectively some sort of a pause button which has sort of got hit, where there is some caution amongst both the founders and the investors on the cap table to sort of look at what is the right time to access this the public markets, especially in this globally sort of uncertain world where different forms of capital which actually play in the public markets in India have different viewpoints on how this will span out as a exposure for them. So that's where 25 has been a bit of a caution, but I'm positively optimistic for what's coming up in the remaining 6 to 12 months ahead of us.
Okay, so you covered a lot of ground. Let me break it down. So you mentioned IPO has been the bellwether, has always been relied upon for exits in India for the for the startups, right? So M&A markets haven't been so developed as the US or European markets. So IPO has been the focus for the exits. One. Second, you mentioned in 2023, due to regulatory kind of changes, things opened up. And the benefits of that we started seeing in 2024, which is sort of a bumper year for the exit market. And you mentioned quite a few names. And right now, what is happening in 2025, there is a positive caution within the market. But you mentioned it's not because of the Indian ecosystem, it's rather because of the macro factors. Did I get all of that right?
Probably a couple of corrections on that, Rohit, if you
Okay.
don't mind, to get it factually right. 21 was when the regulatory environment changed. It allowed the likes of Paytm, Zomato's, which is Eternal, all to access the public markets. 5, there is caution. Let's caution through both from the macroeconomic and external factors, but it's also a lot to do with the company and its board, the founders and the investors, sort of taking a very deeper look in terms of their own readiness to tap into the public markets. And we can go into details of that.
Okay, so perfect segue. Let's talk about the IPO readiness. And because there have been portfolio companies who have IPO'd from your portfolio, and there are certain companies which are ready to IPO. So, what are the KPIs that you prepare those startups with, or, for example, the public markets look at?
I think the public market investor, both the institutional and the retail investor, is effectively looking for assets which have a very clearly defined, predictable journey ahead of them, right? And by predictability, we not only mean an ability to forecast your revenue trajectories and your profitability numbers quarter over quarter, year over year, and at least be in the ballpark ranges of those predictions, but also to be able to push the thresholds, because let's not it is a given that the venture-backed startups which have accessed the public markets, sort of technology-led platforms as well, that they have always seen a definitely higher multiple than what the legacy players have been able to trade at in the public markets. To justify that, it has to be on the back of superior growth and profitability, sustained profitability numbers. So the readiness that I think today internally companies are checking for is around whether quarter over quarter, are you able to define a trajectory even internally to their own current board and be ready for public market access, because that narrative of having missed some of the predictions, not being able to communicate the business model in its complete nature, sort of, I would say, makes the analysts and the investors in the public markets go a little bit, rather than diving into the asset after post listing, right? So the post listing trajectories of any stock, I think, needs a very clear understanding amongst the players in the ecosystem, and that building that narrative, building that knowledge and capability is also a part and parcel of some of the roadshows and the conversations which the founders and the company's board has in the preparation for a public market issue. So I think these are the few factors, I think, internally at least, that companies today are prepping on before clicking the go ahead button on accessing the public markets.
Anoop, is Chiratae also preparing their portfolio companies, and how are they preparing those companies for the IPO?
Chiratae has been working very hard with its late stage growth portfolio in preparing and working along with the founders and ensuring that the learnings from the past companies which access the public markets are effectively incorporated in the journeys of these companies as well. We have been constantly giving guidance on how do we present the company's model out there so that it is well understood by the public market analysts, and also to ensure that both from financial and governance perspective, the company is at the highest standards so that the asset is effectively looked sought after by the institutional investors, who then ensure that the asset then is having a good run both in the book building phase as well as post listing phase as well.
Okay. Got it. And so, with respect to this KPIs, do the venture capital firms within the ecosystem have certain KPIs in their mind? For example, with respect to revenue, can you share some numbers which are probably being discussed in terms of profitability?
It is obviously it differs from the industry to industry, right? The numbers that we may have will be different for a retail company, a brand, or a technology platform that is going public. But broadly speaking, I think what we are looking to gauge is a superior growth rate of revenues, which is today at a steady state, because these companies are accessing the markets after hitting, about anywhere between 5 to 10 years of their journeys have been passed. So the growth rates over here that we're talking about is anywhere upwards of 25%, even as high as about 40%. To that extent, it is almost double or triple of the potential legacy comparables that are out there. So that's one kind of a benchmark. The second, definitely something that we track or we at least advise on, is having 2-3 quarters of profitability at the EBITDA levels at least, so that again it is very clearly understood for the investors, new investors coming into the asset and public market, about the kind of stable growth that the company has achieved, rather than having to invest into the core business to make it profitable in the future as well. So we look at assets and prepare them when they are closer to that quarter on quarter profitability levels as such. So these are the two main aspects. Obviously, there are finer aspects around ROCE, capital utilization, capital efficiency, and other aspects that do come up, but they are different on case-to-case basis. There are business level KPIs as well. If it is retail, we do have numbers around same-store growths, all of these which are then benchmarked against comparables or potential equivalent in the public markets, right? And sort of benchmark to saying, are we ready to hit the public market or not?
Okay. So, shifting the gears a bit, you talked about perception. After IPO, you talked about having a sort of stability with respect to the business model and so on. So, from the retail investor side, do you see there is an appetite which is growing for such tech IPOs in 2025 and beyond?
Clearly, I think there is enough and more appetite available. I think what is key is marrying that appetite and hunger for some of these assets to come into the public markets with the company's readiness in terms of financial prudence, financial numbers standing out, and governance standards standing out as well. If we are able to marry these 2-3 aspects, I think there are good enough domestic institutional investors and also foreign investors in the public markets who are looking forward to some of these assets going public in the next 1 to 2 year time frames that they are today pegged to go public at.
So there is no dearth of demands. It's more about the tech startups being ready to IPO with the right KPIs and so on. So, Anoop, we discussed a lot about the stability of the IPOs. Where do you see the hottest sectors within the ecosystem that are primed to see IPOs in 2025 and 2026?
See, India is a consumption story. Finally, I think the consumer wave, which effectively was the first wave of tech startups as well, when you look at where the private capital went in the early 2000s such. And those are the companies today which have matured, grown to a size and scale, which are accessing the public markets. So we are extremely excited about the India consumer story hitting the top headlines on the public market access. There would be a few consumer fintech companies as well, which will access the public markets, and also the fintech players which have built the entire infrastructure. So those are the 2-3 areas that you would find the next, about 12 months where the maximum action is going to be. Post that is when we will hopefully see that a lot of the we've already seen this happening with many of the companies which were US domiciled from a SaaS domain as well, flip back to India to potentially access the Indian public markets in the future. So post this 12-month phase is when I believe that the potential pure tech startups or the SaaS startups will also start listing more and more in India as well.
Can you expand on this thing that you mentioned about startups which are based in other parts of the world, mostly in the US, flipping back to India? Why is this happening?
Yeah, a couple of reasons. I think one, the reason for being domiciled there itself, Rohit, I think just to clarify that, I think it's the right move when they started off doing that. Because you got to be you will go public in the market where your customers are, right? Because your customers are your biggest ambassadors. They effectively ensure that you are well understood in that market where you're potentially going to list. But what's happened over the course of the last 3 years is the entire, when you look at the US public market ecosystem itself and the participation in the issues, you will find a lot of private capital today going to keeping many of the companies private rather than actually pushing them towards going public, right? That's primarily because the benchmarks of listing in some of those mature markets have significantly gone up from potentially which was 100 million levels for, say, a SaaS company. Now I think the ideal levels will be upwards of 300, 350 million even in those markets, right? To have good enough both institutional and retail participation, which when you look at how the Indian ecosystem has been, there is enough and more capital coming into the public market waiting for good assets, differentiated assets, and with the potential that some of these technology players, the story of having technology players serving from India the global markets is a great story which already in the services market has played out, right? Indian services, tech services market has already played out. And now it's getting repeated or potentially can get repeated in the Indian product ecosystem. So that's one of the reasons why you find, even at a certain cost, you will find a few of these Indian startups domiciled globally flipping back to India to access the public markets here, given the vibrancy and given the fact that they will potentially be rightly priced as well when they go public here.
Got it. I want to flip the conversation and talk about the post-IPO performance, because that's also something that a lot of investors, international investors, look at. For the companies which went or which IPO'd in 2024, can you shine a light on their post-IPO performance?
Yeah, I think it has been a mixed bag. I think it is again, for many of these startups, obviously with a lot of the institutional capital, private institutional capital, which was there on the cap table, one automatic milestone that ends up happening is post the lock-in window, you do find a lot of the institutional capital actually selling their shares in the public market. So supply then potentially outdoes demand, and hence the pricing pressure is a little bit on the lower side, right? It takes the stock towards a bit on the lower side in that window. But beyond that, purely from a performance perspective, I think many of the companies potentially needed to be a lot more, I would say, diligent and deliberate in their forecasts as well, which ensures that once the predictability, the confidence and predictability sets in the public market investors, they can actually price and enter the stock rather than having to wait quarter over quarter for that trend to sort of settle in. So I think a key learning for some of the startups which went public is to ensure that they are far more diligent on how their outlook projections are on the financial side, and if there have been any other sort of distractions in the core business moving away to other avenues of growth. I think the public market investor is very clear that they want to actually look at the core business and see that performance settling down before giving any future value for those other expansions as such. So that's been one key part of the learning for the last 12 months. The other piece is some of the startups which went public had already comparables which were performing pretty well after stabilizing their own outlook projections and gaining the confidence of the public markets. So that also ensured that there is a quarter-on-quarter comparison between some of these assets, which obviously was a lot of pressure especially in this fast growth environment, leading to a lot of leakage in the profitability side, which effectively meant that they were going to be slightly more priced on the lower side as such. So there has been some amount of near-term pressures on pricing for the companies which went public last year. But you do find that after the dig out, these assets are fundamentally great assets. They built a consumer behavior which is long-standing, and they will come back. And as we are seeing also in this last quarter, I think some of the results from the technology-backed or venture-backed startups has been pretty good. I think that journey is going to be continuously improving here onwards.
Okay, good to know. So, what about down round IPOs? There has been a lot of discussion in the US specifically about down round, which means that from the last previous valuation, the IPO is at a lower valuation. To which degree it depends. But do you see the similar case in India, or all of them basically an up round IPO?
I think that level of maturity in India today probably is yet to come in, right? I'm being very frank and honest there. I think it's also a function of the need for going public for assets which are facing that dig out in the valuation. If you are well capitalized in the private market, and you know that the multiples at which your last private market round happened is not what you're going to get priced at when you access the public market. There is no immediate need to go public unless there is a requirement to provide liquidity to some of the early investors on your cap table, right? Which for a good performing asset, liquidity still exists. It's a question of pricing, it's a question of multiple. I think there, over the course of the last 2 years, when the entire so-called funding winter had set in, I think there is enough equilibrium which has sort of come to terms with founders and late-stage growth investors sort of coming to terms on what the right multiples in those markets are. So in India, I think you may not find too many cases where a good performing asset needs to tap a public market and at a valuation lower than their last private market round. And for me, I think it is more of having the capital available to the founders and the company to continue its growth trajectory without compromising the value realization aspects of both the entire shareholders of that particular company. So I think that is the balance that you're going to strike, whether you have enough capital available or not. And is there any immediate need of liquidity for any of the early shareholders for which you need to tap into the ecosystem? Otherwise, you could still be private and still be doing well and go when your multiples and your value is beyond what the previous round was.
Understood. Your post also mentioned about the institutional pricing pressure. What does it mean when you say institutional investors, especially DIIs, are pushing back on the pricing?
Yeah, I think broadly speaking, I think both the Indian mutual fund industry and the financial institutions today play a significant role, because if you'll just look at the amount of SIPs coming into month over month into the public markets, there is a need to deploy that capital as well. And hence they are effectively the supply side giants today who decide which asset looks attractive for them and their investors. And they take a call on where to enter at what price. And hence there is caution in terms of trying to ensure that pricing is something which is not pegged vis-a-vis what a private market investor would do, but effectively through very detailed analysis and long conversations with the board, with the management team, they gain comfort in what potentially is the right pricing for the asset to list in the public markets, right? And it is also a function that once they lock into a price, it locks in their entry NAVs into that asset. And they would also like to ride the growth curve post-listing like any other shareholder would, right? So it is all the shareholders and the ecosystem players having a win-win from a company going public, rather than it just being a set of private market investors alone who then have a sort of a bumper day to get their liquidity in and cash out. I think the idea is to build these sustainable companies for Indian public markets for the years to come, rather than looking at just listing day bump as such. So that is why I think it is a right move that they do have enough control mechanisms and enough supply side power to ensure that these assets are not listing at astronomically high values and are quite reasonable when compared to the public market equivalents.
Anoop, there's another trend of SME IPO exchanges, the small sized companies looking for IPOs in those SME IPO, SME exchanges. How do you see that trend playing out? And do you see this small side IPOs increasing in size?
I think the number of companies going to access the SME IPO exchanges will continue to increase, is my thinking. Is that a preferred mode of exit for some of the venture-backed startups? If that's an option, probably not, right? Because of the kind of liquidity available in that particular exchange today still needs to improve. So while there is an ability to get the stock listed, continued performance of that stock is still prone to a lot of the players who potentially have limited information and hence make these, I would say, biased choices at different points of time, or getting also misled into taking it up onto and entering a stock to that extent. So I think there is a lot more to be done in creating liquidity in the SME IPO exchange for us as overall an Indian ecosystem. But can that evolve as a strong way of companies being sustainable and growing from there on without any pressures on the private market investor side? I think clearly yes. I think we are a few years away from that evolving into a stable ecosystem is what I would say.
Okay. I mean, when you talk about the small size IPO, it's the same story across the world, right? Same as in Europe, similar case in the US, the liquidity is a pressure and it needs to become better as an ecosystem to allow. Nothing bad with it. I think it's a nice outcome for a lot of startups out there, but still a lot of things need to improve. How do you look forward to the next 2 years? What are your predictions?
I think there will be at least 25 to 30 odd venture backed startups which would go public in the next 2 years. And more, you would find the quality of that narrative of these assets which are going public even more stronger than the first two waves that we saw in 21 and last 23-24 periods, right? Because these are founders tightly knit, everyone is learning from each other, and hence you will find better numbers, better governance standards, better communication, and ability to predict their own outlooks to be improving as these companies and these founders hit the public markets. Overall, that will also hopefully open up a lot more foreign portfolio investor participation in these assets beyond the domestic institutional investors and the retail investor, Indian retail investor as well, which hence makes it a very vibrant public market ecosystem that we will have as a well-established avenue for exits, which today the venture capital and private equity ecosystem is yearning to have as a very solid backup to what it needs to build for the future of India.
Those positive thoughts, Anoop. Thank you so much for joining us and covering the Indian IPO sector and your post specifically. Fingers crossed for the Indian ecosystem for the next 2 years. Thanks a lot.
Thank you very much, Rohit. Thanks for having me.